The year 2025 was a golden year for Canada's Big Six banks. It was a period marked by remarkable growth, resilience, and a renewed sense of confidence in the financial sector. As the world watched, Canada's banking giants set new records and captured headlines for their outstanding performance. Their profits shattered expectations, with stock prices soaring over 25% across the board. Investors and analysts alike were stunned by the scale of the gains, as quarterly earnings consistently beat forecasts and dividends reached new highs. These institutions, Royal Bank, TD, Scotiabank, BMO, CIBC, and National Bank, became wealth-generating machines, reflecting their central role in the Canadian economy. Their influence extended far beyond banking, shaping everything from real estate to small business growth. This video will break down the simple reasons behind their profit surge. We'll unpack the strategies and market conditions that allowed these banks to thrive, while others around the world faced uncertainty. We'll explore how banks make money, focusing on lending, investments, and fees. From everyday banking services to complex investment products, each revenue stream played a crucial role in their success. Key drivers like rising interest rates and a booming stock market created a perfect environment for profitability. As rates climbed, banks earned more from loans, while a strong market boosted their investment arms. We'll explain net interest income, the core of their earnings, and how small changes in rates can mean billions in profit. Even a minor uptick in interest rates can dramatically increase the money banks make from lending. We'll also look at non-interest income, from mutual fund fees to trading profits, which became especially powerful this year. These additional streams help diversify their earnings and cushion against market volatility. By the end, you'll see how the mechanics of modern banking turned 2025 into a record-breaking year for Canada's financial giants. Their ability to adapt and innovate set them apart on the global stage. Let's dive into the numbers and the forces behind this unprecedented success, and discover what made this year truly golden for Canada's banks. The numbers from 2025 are staggering. Royal Bank and TD each posted profits of $20 billion, more than some provincial budgets. Scotiabank, BMO, and CIBC each earned around $8 billion, while National Bank pulled in $4 billion. Combined, the Big Six generated profits that showcased an industry firing on all cylinders. Some of these numbers were boosted by one-time events like TD's $15 billion windfall from selling its stake in Charles Schwab. But even without these, the bank's core businesses, lending and investments, were thriving. These profits weren't accounting tricks. They reflected real, robust performance in a near-perfect economic climate. Every bank, from the largest to the smallest, turned 2025's conditions into record-breaking success. The stage was set for a deeper look at how they pulled it off. Let's break down the mechanics behind these massive earnings. At the heart of bank profits is net interest income, the difference between what banks earn from lending money and what they pay out to people who deposit their savings. This simple concept is the engine that drives the entire banking industry, and it's how banks turn everyday transactions into massive profits. When you deposit your money in a savings account, the bank pays you a small amount of interest for keeping your funds safe. But that's just one side of the story. Imagine depositing $10,000 at 0.55% interest. The bank pays you just $55 a year for using your money. It might not seem like much, but it adds up across millions of accounts. Now, let's say the bank lends that same $10,000 out as a mortgage at 4.5%. Suddenly, the bank is earning $450 a year from that loan. The difference between what the bank pays you and what it earns from lending, $395, is pure profit from just one transaction. Multiply that by thousands of loans, and the numbers become staggering. Multiply this by millions of customers and billions in loans, and you see how banks generate immense revenue. This process is happening every day, all across the country, in every major bank. In 2025, this core activity was more profitable than ever, as interest rates and loan demand both rose. Scotiabank alone took in over $21 billion from lending, thanks to a higher net interest margin. This margin is the key number that banks watch closely, because it determines how much profit they make from every dollar they lend. Even a tiny increase in this margin just a fraction of a percent, can mean billions more in profit for banks managing huge pools of assets. This simple spread between lending and deposit rates was a major driver of the year's record profits, fueling growth and rewarding shareholders. Next, let's see how banks maximized every dollar they handled and the strategies they used to keep those profits growing. The magic of 2025 was in the widening net interest margin, the spread between what banks earn on loans and pay on deposits. This margin is a crucial measure of a bank's profitability, and in 2025 it became the driving force behind the financial sector's record-breaking performance. As interest rates shifted, banks found themselves in a uniquely advantageous position. Scotiabank's margin rose from 2.16% to 2.33%. That may sound like a small change, but in the world of banking, even a fraction of a percent can translate into millions of dollars in extra earnings. Royal Banks climbed from 1.54% to 1.62%. These incremental increases, when applied across vast loan portfolios, have a massive impact on the bottom line. These small jumps, applied to hundreds of billions, meant huge profit boosts. For banks, every extra basis point earned on their assets quickly adds up. Why did margins widen? Higher interest rates played a key role. The Bank of Canada's decision sent ripples through the entire financial system, changing the landscape for both borrowers and savers. Banks quickly raised rates for borrowers, but were slower to increase rates for savers. This allowed them to capture more profit from the difference. This lag let banks earn more from loans without paying much more on deposits. It's a classic banking strategy, but in 2025, it was especially effective. Elevated rates meant new mortgages and loans cost more, while savings rates stayed low. For many Canadians, this meant higher monthly payments and less incentive to save. For consumers, borrowing got pricier. For banks, profits soared. The gap between what banks paid out and what they brought in grew wider than ever. This dynamic was the silent engine behind their record year. It powered growth, rewarded shareholders, and set the stage for even more ambitious targets. The power of the spread pushed profits to new heights. It was a textbook example of how small changes in financial metrics can have outsized effects. But there's more to the story. Let's look at another profit booster that helped banks thrive in 2025. Another profit driver in 2025 was the widening gap between the Bank of Canada's policy rate and the bank's prime rates. Historically, this spread was about 1.75%, but by 2025 it hit 2.45%. This means banks charged more for loans, even if the central bank's rate stayed the same. The result? Lending became structurally more profitable. For consumers, borrowing costs rose, and rate cuts weren't passed on as fully as before. For banks, this wider spread was a reliable profit booster. It's a quiet mechanism, but it consistently adds to their bottom line. In 2025, this structural shift was another key piece of the profit puzzle. The system itself now favors higher bank earnings. But lending isn't the only way banks made money this year. Beyond lending, banks raked in billions from non-interest income, fees, wealth management, and trading. Wealth management was huge. Banks managed trillions in assets, charging fees that grow as markets rise. In 2025, RBC's investment management and mutual fund fees jumped by $2 billion. Trading profits soared as markets boomed. CIBC made $4 billion from financial instruments alone. Investment banking also thrived. RBC earned nearly $3 billion in underwriting and advisory fees. BMO's non-interest income surged, mostly from trading and wealth management. In a strong economy, these revenue streams became gold mines. Non-interest income provided a powerful secondary boost to profits. The bank's diversified business models paid off big time. The bank's success was tied to a booming Canadian economy and record-breaking stock markets. The TSX's surge boosted the value of assets under management, increasing fee income without extra effort. A strong market also drove corporate activity. More IPOs, mergers, and share offerings meant more advisory and underwriting fees. Confident consumers and businesses borrowed more, expanding the bank's loan books. Fewer defaults meant less money set aside for losses. The result? Higher demand for credit, lower risk, and soaring profits. The economic environment amplified every part of the bank's business. 2025 was the perfect backdrop for record earnings. Canada's banking sector is dominated by the Big Six, who control over 90% of assets. This concentration brings stability, but critics argue it limits competition and keeps fees and rates high. With few rivals, banks face less pressure to innovate or offer better deals to consumers. The widening gap between central bank and prime rates is often cited as evidence of this market power. Limited choice can mean higher costs and less incentive for customer service. Still, the system is praised for its security and resilience. Regulators favor stability, but the trade-off is less competition. The record profits of 2025 will reignite debate over whether Canadians are paying too much for stability. 2025 was a perfect storm for Canada's Big Six banks. Elevated interest rates widened profit margins on lending. A booming stock market supercharged wealth management and investment banking income. A strong economy meant more borrowing and fewer defaults. Structural advantages, like the widening prime rate spread and market dominance, locked in high profitability. Every part of the banking machine ran at peak efficiency. The result? Staggering multi-billion-dollar profits that dominated headlines. This year showed how Canada's banks are built to thrive when conditions align. The debate over competition and consumer costs will only intensify. But for the banks, 2025 was a masterclass in turning opportunity into record-breaking success.